Your market news now. Asian markets were trying to find a firmer footing after a rough week, hammered by concerns about China's ailing economy and fears of US rates staying higher for longer as long-term bond yields surged. China's stocks have shed 10% from their highs in January as dismal economic data laid bare the stuttering post-pandemic recovery. Meanwhile, a strong run of US economic data, including a fall in weekly jobless claims, suggested the world's largest economy is not slowing as desired in the face of high interest rates, prompting traders to scale back their bets for cuts next year. To give us more perspective, we are joined by Warwick Lucas from Galileo Securities. Warwick, thank you so much for your time. As we wrap up the week, your thoughts on market sentiment and what's driving markets right now?
Okay, so the one-word answer would be cautious. You know, global markets are really still trying to digest the minutes from the US Fed's FOMC meeting, which hinted at likely future interest rates. And of course, with China, I mean, it's all about growth. I mean, they came out of COVID. It looked like there was quite a lot of promise there, and of course, that's really just not followed through. And then, of course, locally, well, in SA, your major industries tend to get driven by the currency, which is, of course, in turn driven mostly by what happens in commodity prices. And with concerns about both growth and the direction of interest rates, well, commodities have been weak. So we've seen the rand in turn been weak in line with those commodities.
You mentioned FOMC minutes rather, but let's look back at the week that was. Were there any themes or company news that caught your attention?
Well, you know, it's always nice when there's some good news out there, and that week that applies to MTN and the building out of their fintech businesses in conjunction with MasterCard. And it sort of shows how a lot of those big technology-intensive businesses, in many ways, they're more ecosystems than just businesses. And I mean, a good international example of that is Amazon. But some excellent developments from MTN there. A lot of value for shareholders.
Let's take it back to those FOMC minutes and perhaps let's have a broader conversation. I mean, when you look at the kind of talk we were having from an industry perspective about what would trigger rate cuts coming into 2023, has anything changed rather so far?
Okay, so I guess there are a few components there. I mean, inflation has become very segmented. The economic dislocations that we saw around COVID caused big mismatches between input pricing, spending, right through the economic value chain and the cycle. And so we've seen inflation more recently has moved from mining and manufacturing products and food into more services and housing. So it's those latter sectors which the Fed is going to want to see some easing off on before they really get going, I think, with commencing rate cuts. I don't think they're that scared of a recession if they had to cause one. I don't think they want to cause one unduly, but nevertheless, it's a casualty they are prepared to take.
On that note, then, it's been quite interesting to sort of hear some of the answers coming through from the analysts over the past week or so in terms of what would be the biggest risk for the Fed. Would it be over-tightening for too long or taking the foot off the brakes too quickly?
Okay, so it's quite a tricky one to answer there. I think the first comment that I must pass is that it's a lot easier to get inflation down from 6% to 4% than it's going to be to get it from 4 to 2. Now, normally I would have said over-tightening for too long is the biggest risk because monetary policy mistakes can be corrected quite simply by changing policy. However, what you don't want is that inflation expectations become structural as well. I mean, that if there's an ongoing expectation of inflation, that can be quite dangerous. And I mean, this is, after all, the highest inflation environment in the global context in almost 2 generations. So really, the Fed does have to tread a very fine line indeed.
You spoke about MTN, and this is obviously on the back of their results coming out. But looking back at the week, we've also had 3 of the local banks report. As sort of South Africa's earnings season gets underway, what are you paying attention to?
Look, I think that the earnings season as a whole is going to be quite tricky. I mean, amongst all of those banks, we all saw some serious bad debt growth there. The likes of Standard Bank were able to show some good earnings growth, but largely because banks sort of tend to borrow in the very short term, i.e., your basic check accounts, transmission accounts, and so on, and they lend long-term, i.e., home loans. But that's just a technical reason for their earnings growth. It still doesn't change the fact that their books are something that they're going to have to watch very carefully. And then, of course, if we look at the likes of Goldfields, well, I mean, mining is quite clearly suffering from unreliable supply from Eskom. And I mean, we're going to see that across a host of industries. So really, I think the earnings season is mostly going to be one that reflects the kind of very low growth environment that we're seeing.
Just quickly, is there a particular sector that is offering value right now on the local market?
Sure. Look, I mean, those who are going to be able to tap into the alternative energy cycle, I think, would have a fairly decent short and long-term outlook. I mean, a good example of that would be Renault amongst the industrials. Perhaps longer-term, your bigger play would be the providers of finance. So I think once they're through the worst of this economic cycle, and their ability to finance these projects, I mean, it provides an enormous lending opportunity for them. But I think they'll only really get going once they've got a better take on what our current bad debt cycle looks like.
All right, Warwick, let's leave it there. Thank you so much for your time. That is Warwick Lucas from Galileo Securities.